silver just had its worst week in 46 years. The price crashed from $91 all the way down to $71.62, and yet at the exact same moment, COMEX registered silver, the physical metal that actually backs every paper contract traded in New York, is sitting at under 90 million ounces, declining 14.1% in 30 days, with 7.1 times more paper claims outstanding than there is metal to deliver. Let me ask you something. If silver was genuinely broken, why is the paper market bleeding inventory while the crash is happening? That contradiction is the most important financial question you can ask right now. And if you do not understand why the paper price and the physical reality are moving in opposite directions, you are going to make the exact wrong decision at the exact wrong time. I have been watching this market for months, and what is happening this week is not what the mainstream financial media is telling you it is. Subscribe right now, because in the next 18 minutes, I am going to show you the specific, verifiable data points that explain why this crash is being misread by almost everyone watching the headline price. Let me start with the mechanism that nobody on mainstream financial television explained correctly this week. Most investors have a mental model of silver that goes like this. When fear rises, silver goes up. When fear falls, silver goes down. Simple, clean, broken, because here is what actually happened this week. The Federal Reserve held rates on March 18th and revised its 2026 inflation forecast higher to 2.7%. Chair Jerome Powell flagged energy price spillover from the ongoing Iran conflict, with oil above $100 per barrel, as the justification for holding a restrictive policy stance. When the Fed says higher for longer, the 10-year Treasury yield rises, and the 10-year rose to 4.25%. Here is the mechanism that matters. Silver produces zero income, no interest, no dividend. When Treasury bonds pay 4.25% annually with zero default risk, every institutional portfolio manager runs the same calculation: hold silver that pays nothing, or hold treasuries that pay 4.25%. When real yields spike, the paper model for holding silver becomes painful. That is the first layer of why the price fell. The second layer is more disturbing. Throughout 2025 and into early 2026, retail investors poured enormous capital into silver ETFs, a significant portion of that into leveraged products, 2 times and 3 times ETFs that multiply every daily move. These products rebalance daily. When silver falls, the leveraged ETF must sell to maintain its ratio. Lower prices trigger more selling creates lower prices. The cycle feeds itself until the leveraged position is fully liquidated. This is not speculation. The iShares Silver Trust, ticker SLV, and its leveraged equivalents gapped lower on extremely high volume on Thursday. The selling was broad, retail and institutional, forced and discretionary. What you saw on your screen was not investors changing their minds about silver. It was the product design of leveraged instruments forcing people out at exactly the worst time. And here is the detail that most people missed entirely. After that Thursday crash, SLV recorded over 32.9 million ounces in a single day inflow. That was the third largest single day inflow in that ETF's history. The bid did not break, it relocated lower, and someone with very large capital was on the other side of the retail panic, buying. Drop a comment right now. Type hold if you are not selling a single ounce before silver reclaims $100. Let me see how many strong hands are in this audience. Now here is where the story gets genuinely important, because while the paper market was doing what paper markets do, reacting to yields, the dollar and leverage mechanics, the physical market was sending a completely different signal. I want you to understand the COMEX registered inventory number, because it is the single most important data point in the silver market right now, and almost no mainstream financial outlet is talking about it seriously. COMEX registered silver, the metal that is immediately deliverable against futures contracts, has fallen below 90 million ounces. A few weeks earlier, it broke through the 100 million ounce threshold for the first time in years. It has now declined 14.1% in just 30 days. 13 million ounces withdrawn in a single month. The coverage ratio, the percentage of outstanding paper claims that could actually be satisfied with real metal, stands at 14.1%. Below 15% is considered stress territory by the exchange's own risk frameworks. Historically, those levels are rare. And here is the number that should make you stop whatever you are doing right now. The current paper to physical leverage ratio at COMEX is 7.1 times. That means for every single ounce of silver available for delivery, there are 7.1 paper claims outstanding. 7 paper promises for every real bar sitting in the vault. At the current withdrawal pace, registered silver would be exhausted in approximately 134 trading days. That is not a conspiracy theory. That is COMEX's own warehouse reporting math. Every reference I cite is in the description below. Now I need you to understand something about the historical context here, because this is where the source video's framing, as thoughtful as it was, missed a critical layer. The transcript you may have watched, the one talking about the mechanism problem, the Gulf sovereign selling, the 40-year pattern, that video correctly identified the dollar and yield mechanics. Where it left viewers with an incomplete picture is in explaining why this particular crash is different from a standard macro-driven correction. And the difference is the physical inventory signal. In 2008, during the financial crisis, silver crashed from $21 to $8 in a matter of weeks. Investors who held physical came out the other side of that crash. The paper price recovered and surpassed the previous high within 2 years. What was happening in the COMEX vaults during that crash? Inventory was rising, not falling. Metal was moving into the registered category, not out of it. The signal was the opposite of what we are seeing today. Today, the paper price is falling while physical inventory is draining. That is a different pattern. That is the pattern that preceded the biggest single-year rally in silver's modern history, 2025. Hit the like button if this is giving you context you have not seen anywhere else this week. This data matters and it needs to be seen. Let me give you the 5 data points that the mainstream crash narrative is not connecting. Number 1. COMEX registered silver has dropped over 70% since 2021. The drawdown did not start this week. It has been a multi-year structural drain, and the crash did nothing to reverse it. Number 2. Global silver has been in supply deficit for 5 consecutive years. The Silver Institute projects the 2026 shortfall at approximately 200 million ounces. Annual mine production is approximately 830 million ounces. Annual demand consistently exceeds 1 billion ounces. That math does not care what the paper price is doing on any given Thursday. Number 3. After the January crash, SLV recorded its 3rd largest single-day inflow in history, 32.9 million ounces in one day. Institutional buyers, not retail, were accumulating at the lower price. Number 4. JP Morgan's 2026 year-end gold price target is $6,300 per ounce. Deutsche Bank holds a $6,000 target. Neither bank moved those targets after this week's crash. That is the signal professional analysts actually watch, not what institutions say in press releases, what they do with their price targets when the short-term price moves violently against them. They did not move. Number 5. The Shanghai Gold Exchange continued trading at a premium to the COMEX paper price throughout this entire crash. Asian physical buyers did not step back. The paper market said sell, the physical market said buy. There are 3 types of investor watching this price action right now. The first type is scared. They are watching $71 on the screen after buying closer to 100, and they are calculating their loss. The second type is confused. They cannot reconcile why war, geopolitical chaos, a 5-year supply deficit, and draining vault inventories are producing a falling price. The third type understands the forced liquidation paradox. They know that in 2025, silver rallied 135%. They know that the same leveraged products that drove the price from $25 to $121 in 12 months are the same products that, by their design, force selling at exactly the moments when the structural case is strongest. They know that the paper price is a real-time report on leveraged positioning. The physical inventory data is a slow-moving signal about genuine scarcity. And they know that physical reality always wins, not always immediately, but always. Tell me in the comments, are you type 1, type 2, or type 3 right now? I want to see the honest answers. Let me give you the two numbers that will tell you more about where silver goes next than any daily price chart. The first is the 10-year Treasury yield. It is currently at 4.25%. When that yield breaks back below 3.5%, which happens when recession fears overtake inflation fears, or when the Fed is forced to pivot because the arithmetic of $36.2 trillion in national debt cannot sustain 4.25% rates indefinitely, the mechanical headwind against silver reverses. The United States is rolling over $9.2 trillion in debt this fiscal year alone. At 4.25%, that debt costs $391 billion more annually than it cost at 2% rates. The second number to watch is the DXY, the dollar index, currently at approximately 99.9. When the DXY breaks back below 97, the inverse relationship between the dollar and silver flips to a tailwind. Both of these numbers are the product of a temporary macro configuration, a hawkish Fed, an oil shock, and a leveraged liquidation. None of them represent a structural change in silver's supply deficit, its industrial demand trajectory from solar panels, electric vehicles, and artificial intelligence infrastructure, or its monetary role in an era of $36 trillion sovereign debt loads. Share this video with one person who is watching the price and not the inventory. They need to see this data before they make a decision based on the wrong signal. Here is my analysis-based outlook. And I want to be transparent that this is not financial advice. Every person watching this video must assess their own situation, risk tolerance, and investment timeline. Based on the historical pattern of paper physical divergence, based on the fact that institutional price targets at JP Morgan and Deutsche Bank remained unchanged through this crash, based on the reality that COMEX registered inventory is draining toward crisis levels while open interest remains structurally elevated, and based on the 5 consecutive years of physical deficit, my analysis suggests that the $70 to $75 range represents a structural accumulation zone rather than the beginning of a new bear market. The May Federal Open Market Committee meeting is the next major catalyst if economic growth data shows any softening and the GDP signals are already mixed. The probability of a Fed pivot or even a rate cut begins to reprice. When that happens, the 10-year yield and the DXY react before the Fed actually moves, and that is when the mechanical headwind against silver reverses, not because the world suddenly decides silver is valuable again, because the two variables that created the temporary paper sell-off stop working against it. There are 3 types of investors watching this right now. The scared ones are selling into the panic, locking in paper losses, and will watch the recovery from the sidelines. The confused ones are frozen, unable to reconcile the contradiction between a crashing price and a draining vault. And the prepared ones, the ones who understand the forced liquidation paradox, who have been watching inventory data alongside price data, who know what a 7-to-1 paper to physical leverage ratio means when delivery season arrives. Those investors are not panicking. They are paying attention. Which type are you? Drop your answer in the comments below. If this breakdown changed how you understand what is happening right now, share it with one person who is making decisions based only on the headline number. Hit subscribe and the notification bell. The data I track in this market does not show up on mainstream financial channels, and I will see you in the next one.